Recently, Google Trends recorded a sudden, massive spike in search interest across the United States. A flat baseline of curiosity transformed almost instantly into a vertical climb. That volume centers on a very specific phrase: Warren Buffett's stock market warning. The climb was triggered by a flood of financial news headlines. Dozens of outlets are simultaneously promoting stories about an urgent 8-word or 11-word warning that investors supposedly need to hear immediately. Market participants react to his name with unique intensity. Decades of success have cemented his status as the primary reference point for everyone from institutional fund managers to retail day traders. While the headlines suggest a new catastrophe, the data points to a different phenomenon altogether, one that relies more on the mechanics of the internet than on any new statement from Buffett himself. This spike isn't the result of a new press conference. Instead, it is the result of a heavy recycling process, where sentences from old shareholder letters are being pulled from the archives and treated as breaking news. The trend is being amplified by automated spam networks. These systems monitor high-value keywords like Buffett and stock market warning, then automatically generate content to capture that search traffic. This leads to bizarre results, like boxing match previews or music remix descriptions that have been injected with the exact phrase Warren Buffett's stock market warning just to gain the search algorithms. This automated noise looks nothing like traditional financial reporting, where news usually flows from verified tickers and direct economic reports. This is algorithmic media recycling. In this system, the search volume itself dictates the creation of content, rather than real-world economic events. These digital loops take decades-old financial principles and wrap them in a sense of immediate, artificial urgency to keep the cycle moving. The current anxiety is a reaction to a media ecosystem that has been mathematically optimized to prioritize fear over new information. To find a real economic signal, we have to look past the headlines at the historical facts that actually built Buffett's reputation. In 2001, Buffett proposed a specific metric to help investors gauge the state of the market. It's now widely known as the Buffett Indicator. This chart visualizes the concept. It compares the aggregate value of the stock market against the nation's gross domestic product to determine if stocks are cheap or expensive. When market value climbs significantly higher than actual economic output, the indicator signals it is overvalued. Buffett has used these types of structural signals before. In the lead-up to the 2008 crash, he warned about the ballooning value of OTC derivatives, famously labeling them financial weapons of mass destruction. The 2008 financial crisis proved the weight of those warnings, as the collapse of those overvalued systems eventually required massive government intervention. At that time, reporting focused on specific data points and balance sheets, a sharp contrast to the vague, automated slogans filling today's feeds. Buffett's documented warnings rely on structural macroeconomic data, metrics that move over years, not sudden 11-word soundbites designed to move over minutes. The current panic is driven by a confusion between a media feedback loop and an actual market collapse. Trend data often spikes due to short-lived news cycles. This rapid movement represents temporary interest, not a durable shift in economic fundamentals. Early reports in these cycles are frequently incomplete or context-free. Treating these volatile bursts of speculation as settled fact is a high-risk approach to investing. Analyzing the current market requires moving beyond the viral noise. While this isn't personalized advice, historical trends suggest that the most reliable information is found in long-term data. Returning to the 2001 indicator provides a grounded perspective. It functions as a sober valuation tool rather than a catalyst for sudden, emotional decisions. The persistent danger for investors today is the fading line between fundamental economic metrics and manufactured viral trends.